One of the things you talked about in our last interview was, that you felt like there was going to be a wave of active managers entering the space. Has that happened? Give us the state of the active managed kind of ETF market.
It is, yeah, it is Wild West. There is the money is coming, and it's coming in fast. So, as of the end of last year, you had about $300 billion in actively managed ETFs. That was up from $200 billion a year before that. So $100 billion of capital flowing into 50% growth in a single vehicle of investment is awfully fast, and it does not appear to be slowing. So if you were to look today at ETF launches, it has now in fact become easier to launch an active ETF than it is to launch a traditional index-based ETF. Now, the challenge with that is because the barrier to entry has fallen so low, that means that you've gotten a much wider variety of what is being called an actively managed ETF than what might traditionally be considered an actively managed fund. So in our view, a traditionally active managed fund this is a benchmark. It is our job to beat that benchmark with as little volatility as possible, and investors can measure us against that. Most of the actively managed ETF, air quotes, that have come out aren't doing that. They're coming out and saying, hey, we're active because we're also overlaying some option strategy. And so you've had a lot of equity-linked income products have been kind of the most popular thing this year. It's hard to see that because investors don't realize the costs that they're assuming in participating in a strategy like that. They don't realize what they're giving up relative to S&P 500 performance in general. But sometimes those products can sell because you're telling someone, hey, we're going to give you equity returns, plus you're going to get some cash out of it. And that can sound good to an investor, but if they're not doing the hard work of figuring out how that's truly benchmarked about what they could get if they own broad indices, they're losing some of the spread in that entire process. So there's a lot of stuff going on out there. There's conversions. Some of the large mutual fund houses have begun to convert a couple of funds. Vanguard, BlackRock, Capital Group, they're all now officially in the actively managed ETF space. For the most part so far, though, these really large managers, they've entered the space, but they're not penetrating it. So with whatever funds they brought to it, that's sort of where they are right now, and it's probably going to take them a handful of years, as it's taken us, to figure out how to make the product relevant to the market that they're trying to sell it to. So, but look, it's still really early. I mean, actively managed ETFs are just a little more than 2% of the 12 trillion in actively managed AUM out there, and we see that penetration getting to at least 10% over the next 5 to 7 years.